Good afternoon, everybody. Good morning to my friends in Torrance, California. I hope you guys are doing great. Happy Fed Day for all who celebrate. I am Mark Sebastian. I am the founder and CEO of OptionPit.com, and I am joined by our own Director of Education, the Viking of Volatility. He is Andrew T. Giovinazzi. Good to see everybody. I see we're coming in from all over the country. We have a lot to cover today, including this Fed rate decision. Really, there may be some interesting things in the statement, but more likely we're waiting on Powell to speak. But that doesn't mean we're going to waste your time. Don't worry. We've got a lot to talk about because I believe there is a big market-changing event heading our way. And we're going to talk about it. So let's dig in. Today, we're going to talk about what is a Fed fund future and what are we actually watching. Andrew's going to talk about why the government is pushing for rates to drop. We're going to, second here. Andrew's going to talk about, what lower interest rates incentivize, and then we'll do some big reveal, and then we'll look at some short-term opportunities and some long-term opportunities. So I want to start with what is the Fed fund rate? How many people know, we got close to 400 people here. How many people know what the Fed actually changes? Because I'll tell you, it's not the rate the government borrows at. It's not the rate for your mortgage or your car loan.
I won't answer this.
Thank you for not doing that. The 24-hour loan bank borrowing rate banks overnight. So that's called so you guys are saying it's the rate banks loan back and forth overnight. Kind of. That's called the effective Fed funds future rate. All right. They actually change the rate that banks borrow from the Fed directly. Now, the Fed is the lender of last resort. So if I'm a bank that needs to borrow money, I can go to the Fed, for a night. I can borrow money directly from the Fed. Now, that almost never happens. It is such a bad look for a bank. That really only happens in an 07, 08 type banking crisis. And typically, if a bank is going to be borrowing from the Federal Reserve, that also means that your FDI, your Federal Depository Insurance Corporation, is going to be cutting checks. But banks do loan back and forth to each other, and that is basically set off of the Fed funds rate. And the Fed funds rate has a waterfall effect across the whole market because big corporations borrow short-term as well in what's called the commercial paper market. That is closely tied to the Fed funds rate. So when these rates drop, it frees up liquidity. It frees up capital. It lowers the amount of what the banks are getting for the deposits, so they're more likely to want to move it in other places. That liquidity that is created by banks having more money and corporations having more money waterfalls its way through into treasury markets. So what are the treasury markets? Well, the government needs to borrow money. Currently, a lot of money. You might even call it an obscene amount of money. All right. So the freeing up of all that capital, one of the places banks will go, foreign governments, you name it, is they'll want to get some return on that liquidity. They'll go into government debt markets and they'll start buying government debt. Now, I know most of you are probably aware of the relationship between bond prices and interest rates. but I'm going to make sure everybody is. If demand for bonds goes up, what is going to happen to the price of those bonds? Hint, it's the same thing that happens to the price of stocks when the stock goes up, when demand for a stock goes up. Yeah. If demand for bonds goes up, the prices of bonds go up. When the cost of a bond goes up, what happens to the interest rate associated with that bond? And Andrew, I know you know the answer to this one as well. Right, rates go down.
I'm trying to go 2 for 2.
Right. Rates go down. And when government rates go down, that spills into the auto loan market and, more importantly, into the mortgage market. Anybody notice what's happened to mortgage rates in the last week? Last 2 weeks? Yeah, they've gone down. Why? Well, Andrew's going to answer that here in a second. Because it's not like this happens in a vacuum. How many people are expecting a rate cut? Raise your hand. There's over 400 people in here. How many people are expecting a rate cut?
Although we have one student who doesn't think so, but we do have one, but mostly right. Yes.
Looking here, it looks like just about everybody's expecting a rate cut. Now, do you think capital markets, which are fueled by Goldman, Morgan Stanley, Merrill, Merrill/Bank of America, otherwise known as BAML, and JP Morgan, do you think those guys are smart enough to get out in front of this?
Potentially,
me too.
Yeah.
Me too. So, Andrew, what have we already seen in markets across the bond market that as we anticipate this Fed announcement? I'm going to go on X and be ready for this news.
So yeah, the market's already anticipating a rate cut because rates are lower, right? Market's forcing rates down because they believe it's going to happen. That's where they get the high confidence with the Fed fund rate cut. What also baked in is how much we think the market's going to move. Right now, they're looking at 80 points SPX for the week. That number has steadily gone up since Monday. On Friday, that was about 775 points SPX. Now it's around 80 points SPX, and that's 2 days closer. So all the option premiums have expanded as everybody gets a little more nervous going into this number. And the big impedance is the government, as in the White House, wants lower rates. The problem is Congress keeps spending money, pushing inflation up that way. So the Fed is stuck trying to walk this tightrope. So they do have a mechanism, Mark, I believe, for trying to unwind this twist they are in. Right? They are they're in a bind between the White House wanting one thing to service the debt and Congress doing another thing, spending more money than they take in. And it has put them in a bind that they can somehow twist out of, Mark. Could you maybe explain that?
Yes, I see that there is. I definitely see there was a pun intended there. So what Andrew's hinting at is that right now with the government owing about $35 trillion, the government is paying more in interest payments than they're spending in the Department of Defense. And folks, we know how much our congressmen like to spend on tanks and planes and drones and everything like that. It is a $1 trillion budget. But we're actually spending more servicing our debt. So the hope, remember I talked about demand for treasuries, demand for government bonds. So the hope is lowering this rate, that waterfall effect that goes into government bonds, lowers interest rates. If interest rates go lower, does the cost of servicing that debt go up or down? If the government is paying a lower interest rate, what happens to their cost of servicing the debt? Right? If you removed debt servicing, the budget would be pretty much close to balanced.
Yes, very close.
In fact, I believe we'd be in a surplus. I think the deficit is about $800 billion. All right, we're a minute away. We're watching these things very closely. We're getting a little bit of a rally here ahead of the Federal Reserve. Now, in order for bonds to go up and inflation not to take off, the Fed has to get the rate of these cuts, so the speed of the amount of cuts, perfect. All right, let's see what we got. Oh, we got a pop here, folks. We just jumped. We're currently at a new all-time high. We're coming off of it a little bit. Obviously, you get this initial news reading headlines. They don't really mean a lot. If you want to share my screen.
Oh, we got a new low in the vol products all of a sudden.
Bond, VIX is going down.
But now we have to wait for the next.
All right. Fed cuts 25 basis points as expected. Fed median projection shows a 50 basis points more cuts in 2025. And Trump's brand new nominee to the Fed, Governor Murin, dissents in favor of a 0.5 point cut. Call me shocked.
Call you surprised.
I cannot believe that the brand new appointee of President Donald Trump is pushing for a more aggressive rate cutting regime.
That is unbelievably shocking.
Now we're waiting to see what their statement has to say. Fed projections show 9 of 19 officials see 2 additional cuts, 2 see 1 cut, 6 see no more reductions. So interesting. That is important, guys. So really only the plurality of the 19 officials see 2 additional cuts. The majority see a minimum of 1 cut. But a full third of Fed governors see no more cuts. Pretty interesting stuff, to say the least.
Well, that should start to paint a picture for us.
Yes. Now, while we're kind of waiting,
what the next few months should look like.
Yeah, I think that the October session is going to be, so the Fed's next meeting after this one is definitely one to keep an eye on. That October session is where we're going to really figure out whether there's going to be 2 more cuts or 1 more cut. All right.
Where's
now,
the current projection for that, Mark? Already?
all right. Statement is coming out.
That's a candle.
That is a candle. Nice little 5-minute candle there. The 1 minutes look very strong. You can see the market is taking off. It's liking what it sees. That doesn't necessarily mean it's going to stay there. Remember, the first move the Fed is often not the right move. Fed says downside risks to employment have risen. That's the statement. That's the piece of the puzzle they liked. Now, as Andrew and I were saying, while we're kind of watching this play out, this process of lowering rates, they have a balance, right? If they lower rates too fast and too much liquidity enters the market, what's going to happen to inflation? What is going to happen to inflation if there's too much, if the economy gets too hot? Yeah, you could see a jump in inflation. Now, what happens if they cut rates too slow? What happens if they cut rates too slow? You could see the economy have a recession. Worst case would be stagflation, which means we have inflation and a stagnant economy. So they have to get this perfect. Now, Andrew.
Yes.
Written history goes back to about the time of Egypt, I would argue, right? Maybe a little before that.
Maybe a little before.
You go to the Chinese, if you want to go to the Chinese, you're talking, modern history goes back about somewhere between 5,000 and 6,000 years.
Okay.
All right. In that time, by my recollection, there has been exactly one perfect person. One. And as perfect as that guy was, I don't know if he could get this right. So they're going to screw this up. Oh, I forgot about the Buddha. Excuse me, South Bay.
Tom the Vixed. It didn't work out. Yeah, it doesn't pay to be perfect, I guess.
Yeah. So now here's where we run into the problem. Short-term rates are low, but the government is still issuing way too much debt, right? Servicing is still too high. What are they going to do? They're going to do what's called a twist. They're going to do a twist. Now, does anybody know what a twist is? And no, it's not Chubby Checkers. Come on, baby.
I just knew that was
doing
coming.
a twist. Come on, Paul. The Fed's doing a twist. Yes.
That wasn't a bad impression, actually.
Well, thank you. So when the Fed twists, what they're going to do is the area where bonds are going to be cheap from these rate cuts are going to be in the 90-day note, the 6-month note, the 1-year note, or I'm sorry, the 90-day bill, the 6-month bill, the 1-year bill, and the 2-year note. Where things are going to be expensive is in the 10-year, which is really what your mortgage rate is priced off of, and in the 30-year. 5-year too. Will that cause an inverted curve? No, that'd be a normal curve. Normally, we expect rates to be lower in the front and higher in the back. Right now, they're a little screwy because of projected rate cuts. So, what? And this won't come until after we get a new Fed chairman in December. You will see the Fed selling near-term bonds. The 1-year bill and the 2-year note. And they're going to use those proceeds and they're going to buy the 10-year and the 30-year.
Gold just made a new high. GLD,
yes,
I believe.
Dude, the Russell 2000 is taking off. So what this is going to do is they're going to force government borrowing costs to drop. They're going to force mortgage rates lower in an effort to boost the economy and reduce inflation. Now, here's the problem. It's a pretty nice Band-Aid. It's a pretty nice Band-Aid. But can that last forever? What do you think, Andrew? Can that last forever?
Generally, it doesn't. Generally, nothing lasts forever. Well, some things can last forever, but not that.
Yes. So what the next Fed chairman is going to do is essentially enable Congress to continue to spend our money like it is water. They're going to spend our money like it is water, which they already do. And it's going to be financed, or it's going to seem not that bad by this twist. It's going to be great for me. It's going to be great for Lauren. It's going to be great for Andrew. It's going to be great for just about everybody here. Right now, as I'm speaking, Valentino, sitting in 3rd grade class, has a little tear coming down the side of his face. He's like that Native American that looks out over the trash, from the environment, from that commercial back in the 70s.
Yeah.
There's Valentino with just a little tear coming down his eye. Because he knows that the ridiculous selfishness of our congressmen who are more interested in getting reelected than doing what's best for the United States is absolutely screwing him. All right, now, lucky for a little Valentino, he's got Big Mark for a dad. And you're saying, Mark, why'd you just call yourself Big Mark? Well, because my son is Little Mark, even though he's like 2 inches taller than me now. So
opportunities. What are our opportunities coming?
Exactly.
What happened to our SPX candles?
Well, we're still waiting on Powell. We're still seeing
right.
what Powell's going to say. I told you guys, kind of ignore this. The only area where we're seeing real gains right now is the Russell 2000. I'm going to talk to you about why here in a second. So,
well, that's why. So short term, that also means we're not going to see real moves in volatility. Although we did some of the early volatility that we had from the week, they're starting to take out now because now the rate cut is known. But we're not going to see a real collapse. That's not going to just happen today. It's going to take a couple of days for that to sort of weed out.
absolutely.
We need a little more Powell information.
So what you're seeing right now with the S&P selling is because of the nature of the S&P 500. So the S&P 500 is 33% 8 names. The NASDAQ is 67% 8 names. Those names don't need to borrow money. They might, because why not when it's cheap and easy? But they don't need to borrow money. Interest rates don't really affect them. So as money leaves these names, where is it going into? Industrials that actually need to borrow money. Remember my little talk on commercial paper and them getting capital freed up? They're a big beneficiary of rates going down. And the Russell 2000. These are small cap companies that have real debt because they need money to actually like build their factory, put money into their research of their new biotech drug, or they're a bank or an energy company that needs to borrow money to build the wells that they're trying to dig, or the mine they're trying to get lithium or rare earth out of. All right. So
I think this is like market pinball right now.
Yeah.
The market is swatting back and forth with zero liquidity.
Yes.
This is more like
this is just noise and nonsense. You can ignore both sides of this until Fed starts to speak. Tell Mr. Powell. Gold makes some sense. Fed, inflation has moved up and remains somewhat elevated. So maybe that's what spooked them. These are all, what you're watching here is not people trading, it's news reading algos. So, Andrew, with what we've got, and now knowing what we know, there are all kinds of, and I'm going to talk to you about some long-term opportunities here in a second. But we want to get this wrapped up so that we can all watch Powell together. Super fun. So, what kind of short-term opportunities do you see here in the market once we get a little bit of a calm down here?
I mean, short-term opportunities, there's opportunities for volatility and vol products go down. I think that is the short-term easiest one I can think of. Once all this news is out, you're going to get some kind of a path on rates. And once you have a path on rates, the future becomes more certain. And when there's more certainty, stocks like that. So even though the market is kind of beaten back and forth right now, ultimately we're going to get some story out of them. And that's the way, we're set up in weekly profit cycles for that kind of vol down trade with predominantly leaning short vol. The second part is interest rate sensitive stocks could also get a little bit of a boost. I think you mentioned IWM, but also stocks that pay high dividends all of a sudden look a little better with rates a little lower. So those aren't necessarily stocks in the queues. Those are more stocks, in the S&P 500 in the Wilshire 2000, places like that are going to benefit more from a slight drop in rates. But also, he's saying, the funny thing with Powell is he just said we got a little uptick in inflation, but I cut anyway. But he's cutting mostly because of the job market. So from an opportunity point of view, today is kind of just the appetizer for the rest of the week. Generally, once the Fed has their open market committee meeting, the trend you have is pretty strong for the next 3 or 4 days. So, because everybody's been sitting and doing nothing for a week. If you pull up a chart of the last week, Mark, what did the SPX do?
We are exactly where we started 5 days ago.
Yeah. So no one's done anything. So, you have a lot of traders, investors just sitting around waiting. And now they don't have to wait anymore. And that's the moral to the story. So you will see some action in interest rate sensitive stocks. You will see some action in volatility, because all of a sudden 30-day volatility is now looking toward the middle of October, right? Starting to get into that fall holiday season. Earnings coming out. So there are a lot of cyclical reasons also for volatility to drop a little bit. But you've taken a lot of big volatility items out of the news cycle. The tariff thing is pretty much
done.
Done. If we have the job market is starting to soften, the inflation picture should ease. And you have rates a little lower. So that cocktail for stocks going higher is pretty stiff still, I think, right now. Very stiff.
Yeah. So, Andrew, I really like your idea on dividend stocks. Now, I'm going to share kind of my long-term play here in a second. But let's say that Powell really hints, yeah, we're probably going to cut more. Right? Because right now that's still a little bit up in the air. They're pricing in about a 75% chance of a rate cut in October now. And call it a 90. Yeah, they've got us basically down to, they're up in the air about 1 or 2 cuts. Right? Currently, we're at 4 to 425. By December, they have us about 92% that will be at that third rate cut. Now, that could change while we're talking here today. But assuming that that is online with what kind of we're expecting, what the Fed really says, yeah, we're down to play ball. 93% chance of a rate cut now in October. If the Fed says we're down to play ball, Philip Morris pays a huge, or no, this is Altria, sorry. I always call it Philip Morris because it was Philip Morris for years, right?
Yep.
Altria.
I mean, Altria is such a dumb name.
It's a really dumb name, but it pays a massive dividend. Over $1.06 a quarter. $1.06 a quarter and only going to go up.
Yep.
$65 stock. What's the div yield on that?
It's like 6%.
Yeah, 106 times 4 divided by 65. Yeah, you're getting almost a 7% dividend on that. With rates coming down, do you think traders are going to be like, hey, this might be a fun one to own?
I think a lot of investors stocks will look good.
Yeah, it's going to be great. This stock will probably go up. And it's off, and it's had Since August, it's come down $4.
Ever since they started talking about rate cuts, which is very strange.
Yes. Hannah says, Mark, we've just had a few more people join us. Can you sum up where we are so far before Powell comes on? So Powell, the Fed has dropped rates by 1/4 point. The plurality of the committee thinks there's going to be 2 more rate cuts this year. About 1/4 of them think there's going to be 1 more rate cut, and several think there's going to be 0. In terms of short-term opportunities, Andrew just said dividend stocks are going to have a really nice run for the next 4 or 5 days as we recalibrate. Assuming Powell confirms what we're inferring. And Justin, can you move us to the other side or below? Assuming what we're inferring, names like Altria, maybe not Philip Morris, but these high dividend yield stocks are going to make you some money owning. All right, now, in terms of investing, I want to show you guys something real quick. All right, so, what you're looking at is the 1-year return of the S&P 500, the Triple Q, the Dow, and the Russell 2000. Now, we just told you Dow stocks and the Russell 2000 are going to be huge winners in a rate cut regime.
Hey, Mark,
what indexes have been the laggards this year? They're both up a little more than 10%. The S&P's up 17. The Qs are up 24. The only index that has not touched an all-time high this year is the Russell 2000. IWM. Andrew, in a rate cut regime.
Yeah, those are the stocks that, because they borrow money, their borrowing costs are going to go lower. That's why those stocks are going to do better. Why are stocks that are already paying a 6% dividend? Think of it kind of like a bond. If interest rates go down, bond prices go up. So stocks that are already paying a high yield, they're going to just look better because that yield is going to look better. All of a sudden, a 6% yield for Philip Morris when your treasury bill rate is going down is going to look pretty good. Who cares if they sell cigarettes? but utilities, even some bank stocks that are paying a high dividend right now, I think, XLF is doing okay right now.
Yeah,
so,
I mean,
there's pretty high dividends in all of these stocks, especially like regional banks. I mean, this is a better thing for regional banks.
Regional banks like Fifth Third Bank,
Key Corp,
that pays a 5% dividend.
Yeah.
Or Huntington Bank Corp. So you've got the dividend stocks, which is the Dow Jones Industrial Average. The majority of those names pay a really nice dividend. B. Micken 1959 says, hey, Verizon's a 6.3 dividend. Yeah.
Yeah.
Or like there's dividend ETFs.
4.2.
Yeah. Stu, the total return ETF. It's going to pay you nicely. Now, if you're looking for kind of something a little sexier, something that can make you money quickly, an index that I believe is going to be the performer between now and the next meeting in October. The one index that is not at a new that has not touched an all-time high in 2025. I point you to my friend, the Russell 2000. They borrow a lot of money. They have to invest. I predict we're already seeing the Russell 2000 approach that all-time high. Now it's having a nice run, but it's still a laggard year over year. It's only up a little over 10%. The IWM is going to be an absolute demon in the next 30 days.
By the way, Mark, wasn't the SPX just down 0.5%?
Yes,
like
ignore everything happening.
Now it's
not. What do I just say? Ignore everything happening.
Unless you're in game plan, I think both zones got tripped in 5 seconds.
Yeah.
You had to be on them in 2 seconds, but
Yes.
both zones tripped.
Hannah asks, hey, Mark, if it's lagging, why would it stop? Well, if their borrowing costs are dropping, their margins are going up. Those grade 8 stocks, they don't really need to borrow money. Their margins are going to stay the same. Maybe they got a little debt out there. But if rates are really going to start dropping, the margin expansion in the Russell 2000, the ones that make money, and there's a lot of banks in there and a lot of oil companies that need to spend money on capital projects to drill. So Hannah says, got it. You own IWM. Am I buying more? Yes. Now, I sold a little bit before the Fed meeting. I was already up a bunch, just doing some risk management. I'm going right back to the well tomorrow. I almost never invest the day of the Fed. But I'm going right back to that well tomorrow. So what would I recommend as an option purchase? Great question. I'm going to answer you with an offer because Powell's about to start speaking. All right. I want you to, if you are currently a member of Option Pit, and a bunch of you are, and then we'll get to Powell. Bunch of you are. Let me know how much, let everyone know how much you like it. And if you're not, and even if you are, we've got something special for you.
Yeah, even if you're not happy, we'll make you happy.
Absolutely. My sales team is on the phones. You can call them 888. Write this number down. 888.
Continue to reduce our security.
872.
I'll have
3301
policy after briefly reviewing economic developments.
If you call them,
Recent
pick up the phone,
growth
say, hey, I'm interested in joining Option Pit. Other than Alpha AI, every single one of our products is at a minimum 20% off the retail price. Every single one. Weekly profit cycles, Zero DTE, Delta Strike, Rip Zone.
Good afternoon.
Turbo Income.
My colleagues
Small
and I
Account
remain
Challenge.
Squarely focused on
Option
achieving our
Shopper.
mandate goals of maximum employment
Pro.
and stable prices for the benefit of the American people.
Trade Zone.
While the unemployment rate remains low,
Every
it has edged up.
single
Job gains have slowed,
product that is
and
Option Pit.
downside risks
Trade to
to employment
close
have risen.
and Game Plan are
At the
not
same
Option
time,
Pit
inflation
products.
has risen recently and remains
And Alpha
somewhat
AI is
elevated.
also excluded. But every
In
single
support of our
Option
goals and in light of
Pit
the shift
product,
in the balance of risks, today the
20%
Federal
off.
Open
Pick up
Market
the phone,
Committee decided
give us a
to
call,
lower our policy interest
888
rate by 0.25%.
872,
We also decided to continue to reduce our
3301.
securities holdings.
and you can join
I'll have
Hans.
more to say about
you can
monetary
join
policy
me,
after
you can join
briefly
Andrew.
reviewing economic developments.
And you can join
Recent
us
indicators suggest
in
that growth of economic activity has moderated.
all the awesome
GDP
stuff we do
growth-
here at Option Pit.
GDP rose.
All
at a
right, so
pace
let's
of
turn up the
around
volume here on Powell and
1.5%
see what he's got to
in the
say.
first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending.
That offer is
In
good.
contrast, business
Till
investment
the
in
end of the
equipment and
day.
intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level.
Short-lived?
But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy.
Short-lived
stance.
is proof that it's
with today's
AI
decision,
and not
we
Powell.
remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027.
Yeah.
This path is
those beautiful
1/4
dot plots.
percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices.
He's been
We
talking for
remain
8
committed to
minutes. and said
supporting maximum
absolutely
employment,
nothing.
bringing inflation sustainably to our 2% goal, and keeping
got a point there,
longer-term
Mark.
inflation expectations well anchored.
It's when they get him on a.
Our
They're all.
success
It's all
in
these
delivering
gotcha
on these
questions
goals
that can be
matters to
fun.
all Americans. We understand that our actions affect communities, families, and businesses.
Once again,
across
give
the
us a
country.
call.
Everything we do is in service to our
888-872-3301
public mission,
and
and we at the
ask
Fed will
about
do everything we can
our services.
to
They'll
achieve
walk you
our
through
maximum
everything we
employment
offer
and price stability goals.
and make sure that you get
Thank
into
you,
the
and I look
right
forward to our
service for
discussion.
you. And again, they're 20% off the retail price right now.
Great. Thank you.
Through
Chris
the end of the
Regaver
day.
at Associated Press.
Here's our first question.
As you know, Fed Governor Stephen Myron has continued, kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Okay, and then just as a quick follow, I'm sorry. Can you, you and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation?
You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation, and actually the increase in
A
goods
little bit more
prices
selling here now.
accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And you know, it's also possible and that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply. And to the point where we see what I've called a curious balance. It's, you know, typically when we say things are in balance, that sounds good. But in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Ooh,
Tim Rose of the Wall Street Journal.
that's
Chair
an
Powell,
interesting
do
tidbit.
Economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. What we can say is this: that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, you can I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that, but we do know that they've moved
A
meaningfully
curious
toward
balance.
greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be
I'm not drinking beer.
warranted?
No.
And how
it's-
seriously was that option
it's
entertained?
the
at your meeting
Gatorade
this
equivalent
week?
of Tang. Yes.
There wasn't widespread
nice dip
support at
there.
all for a 50 basis point cut today. You know, I think we've done
Zero GTE
we've
people
done very large
offers
rate
out on the
hikes and
puts
very large rate
from our
cuts
beta test
in the
track.
last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to to the much lower level of job creation and other evidence of softening in the labor market, and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now. And so that warrants a change in policy.
Colby Smith with the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening? Or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago, with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually, the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off, and that tells you that it's
NFP?
time to take that into account in our in our policy.
So just looking at the SEP once again, the median participant has inflation higher than previously expected by the end of next year, and the Fed not getting back to the 2% target until 2028.
Summary of economic
So I guess I'm just wondering how you characterize the risk to price pressures of kicking off.
A summary of economic projections. See, I don't even know all this lingo.
I would look at it this way. We
hard to keep track of all the
fully
gobbledygook.
understand and appreciate that we need to remain fully committed to restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that the risks there have been less than one might think. And in terms of the labor market, what we're seeing is unemployment is still
They're
low.
really
It's still
selling
a
this thing
relatively
off.
low rate, but we're seeing downside risks.
Michael McKee from Bloomberg Radio and Television.
Keep those questions coming, people.
I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address, how do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs.
I'm about to go. IWM just went
So
red.
I wouldn't say that
now
all
down
of what's happening in the
43
labor market
points.
is due to tariffs. I mean, you clearly have a slowing in it due to
One of the
immigration.
things
You
we
clearly have a
consistently
slowing
talk
in
about is the
demand,
fact that
which is
options
now perhaps more than that
have been
in supply.
underpriced
And we
into
know that because
these
the
events,
unemployment rate has ticked
and
up.
we've seen that happen yet
So,
again today.
So that's what I meant by that.
Like a follow-up, every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028 at the end of 28, but that's literally how
the
you put the
Bloomberg guy?
projections
Yeah,
together.
he's
You're
actually knows what
writing
he's
down
talking
a rate
about.
path, which is designed to create
if I'm forced
over
to
the
watch
course
financial
of the
TV,
SEP,
I'm gonna watch
time
Bloomberg
frame,
instead of CNBC.
2%
It is
inflation and maximum employment.
a little
too.
more
So
boring, but it's a
that's
lot more
all that is.
cerebral, and they actually understand interest
No one
rates.
really knows where the economy will be in 3 years, but the nature of the exercise is.
All right, I
to
told you I never
break down
buy on the
policy that
same
you
day
believe will
as a Fed
return to
announcement,
the 2%
right?
goal over at least by the end of the exercise.
So I unloaded some earlier. I'm gonna wait
Thanks so much, Elizabeth
see
Schulte with ABC News.
how this plays
The
out.
latest inflation report shows that prices are still going up across key categories for many households, including
I
groceries.
can guarantee
What will
you,
the Fed
if she
do
works
if
for
prices
ABC,
pick up more?
if she works for a regular network,
Our expectation
probably doesn't know what
and
she's talking about.
you can see this consistently through the year, has been that inflation will move up this year, but that basically because of the effects
Fun
on
little
goods
watch party
prices
here,
from
right?
tariffs. But
It
that,
is.
those will turn out to be
I think you're
the
still going to
one-time
have a
price
little
increase as
opportunity
opposed
here to
creating
sell
an inflationary
volatility.
process. That's
be
been our
honest.
forecast. Pretty much
Buying
every
some VIX
forecast,
puts,
all the individual
VXX puts.
forecasts say that.
There's opportunity.
We can't
still.
just assume that.
Yeah, if you're
We-
interested in
we
trading
have to-
VIX and
our
learning how to
job is
trade
literally
VIX,
to
then
make
you would
sure
join
that is what
Ripzone,
happens,
or you
and
would
we will
join,
do that job.
Weekly profit cycles.
Right now,
weekly profit
the
cycles,
situation we're in is that we see
which is
we see
targeting.
inflation. We continue to expect it to move up, maybe not as high as
What's
we
your
would have expected it to
2-week
move
target
up
every week?
a few months
Every
ago.
2 weeks?
The pass
close
through
weekly
into
profit cycles, we
of
try every
the
2
tariffs
weeks.
into inflation has been
Yeah.
My
slower and
closing a
smaller.
put spread
The
today
labor
we
market
put
has
on
softened.
earlier.
So
in
the
supply,
Nice.
case
if
for
this
there
keeps
being a
up, you
persistent
actually get a real
inflation
sell-off.
outbreak is less.
All right,
And
the
so that's
Russell
why
is
we
getting.
think it's
We're starting to
time
rebound
for
here a
us
little
really
bit.
to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates
Yeah.
and we try to balance them.
So
And don't
for-
forget, we have
for
Vicky
20%
says she's
off
been
on
averaging
April.
11% a month
when
on
our two
weekly
goals are
profit
intention.
cycles.
This is quite an
That's
unusual
awesome.
situation.
Yeah.
How do we decide what to do? Because our tools can't do two things at once. What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal? So
I'm telling
and
you,
then
he's
that's-
setting
we
up
think
a
about
twist
those things
right
and we
now.
see, as I mentioned, we have been, our policy
gonna
has
try and
been
bring
really
inflation
skewed
down
toward inflation
by
for a long time, really.
Twisting
Now
government
we
debt,
see that there's downside risk.
selling the near
clearly in
term,
labor
buying the
market,
long
and So
term.
we're moving in the direction of more neutral policy.
Concerned are you about the slowdown in the jobs market for households at home, especially younger Americans struggling to land a job?
So it's an interesting labor market, and obviously we think it's appropriate that we reduce our rates so that we become more.
Why would
neutral, which will
RKT
which
be dropping on
presumably
this
will be
news?
better for the labor
Um,
market.
remember I
you-
said like
You see,
markets anticipate this
people
type
who are
of
sort of
stuff.
more at the margins. So
Rich?
kids coming out of college and younger
A
people.
lot of a rate cut was
minorities
already
are-
baked
are,
in, and it may have had
having
a
hard
little
time
more of
finding
aggressive
jobs. The
stance
overall
priced
job
in
finding rate
to
is
itself.
very,
So that would
very
make some
low.
sense. That
However,
being said, it's
the
probably an
layoff rate is
opportunity,
also
Rich.
very low. So you've got a low
Andrew and
a
I
low
both
firing,
like
low
Rocket
hiring
Mortgage.
environment, and the concern is
Do we
that
not? Andrew,
if you start to
you're
see
an
layoffs,
RKT guy,
Yep,
right?
we
the
actually
people
we
who are laid off
sold
won't-
put
there
in
won't be
it
a lot of hiring going on, so
yesterday.
that could very
We
quickly
had a little
flow
strangle going. We're
into,
long call right now.
into higher unemployment in a healthier
Andrew, are you out of your Lulu
economy,
puts?
healthier labor
I was
market,
out
there'll
of
be
my
jobs
Lulu
for those
puts,
people. But now
Markel,
the hiring
last
rate
week.
is very, very low. So that's been a
You are
growing
seeing,
concern over the last
despite the
few
sell-off, you're
months.
seeing
And
volatility
it's one of
come
the
off.
reasons why we
The
think
VIX
it's
is
appropriate
still
that
red
we
on the
begin
day,
to
despite
shift
the
our policy focus.
the S&P being down
toward a more
34
balanced one.
points, 35 points.
Steve Leisman, CNBC. Mr.
Oh, here he
Chair,
is.
in the past, during rate cuts, you used the word recalibration. And I wonder
this
if you
guy.
pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Are we in the process here of getting back to neutral? Thank you.
So I think we're in a meeting by meeting situation. We're going to be looking at the data. You know what? Let me say a word about the SEP really here. So we often point this out.
They've never talked about this before, and now it's been mentioned like 15,000 times.
Of the individual projections of 19 people.
And again,
showing
if
what
you
they
want to
believe at a
trade
particular moment in time
SPX
to be the most likely path
and
for the
VIX,
economy
you can
and thus
join
the appropriate path for
Rip
monetary
Zone.
policy as well.
They can tell you all about it. Give my team a call, 888-872-3301,
try to agree on what that is. We just write them down, accumulate them.
20%
We
off
do
retail
sometimes
price
discuss
today.
them. And so we always say we're not on a preset path, and we really
Fed Day special.
mean that. The actual
Fed Day
decisions we
flash
make are
sale?
going to be based on
Yep.
the incoming data, the evolving outlook, and the balance of risks at the time the decisions are actually made. So you will have seen that we have 10 participants out of 19 who wrote down 2 or more.
Turco
cuts for
income
the
has done
remainder of the
quite
year,
well, Hans.
and 9 who wrote down fewer than, in fact, in a good number of cases.
Leash's
no
deal
more
still
cuts.
open,
So
Earl?
rather than looking
you
at
want to join
so
small account
rather than
challenge?
looking at this
It's
as
20% off
certainty, I
today.
would
Give the team a
encourage
call,
people, as always, to look at the SEP
888-872-3301. Yeah.
through the lens of probability. And so there are
Yep.
different.
You can join
possible
small account
outcomes
challenge. Give them a
and
call.
likelihoods rather than this one is certain and this one isn't happening. So that's what I would say.
Thank you for getting to my
right,
follow-up
we're getting another
question,
push
which
lower
is the
here.
dispersion in the outlook, a sign of uncertainty of policy in the meetings to come. Thank you.
And again,
You know,
if you're in zero
It
DTE
is
and you
such
put
an
on
unusual
my
situation.
XSP strangle,
Ordinarily,
I've sold
when
most of my
the labor
puts at
market is weak,
$4.20.
inflation is low, and
I'm
when
working
the labor
one
market
at
is really strong, that's when
$4.90.
you've got to be careful about inflation. So we have
Give
a
myself a
situation
nice
where we have
credit to own some
two-sided
calls.
risk, and that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views. It's not so much about having different views for the path
Is there
of
a
the
coupon
economy, but
code? No,
it's partly that,
this
but
is
it's
a
also
phone
partly
only.
about
888
what's the right thing to do in light
872-3301.
of this.
You can also shoot them an email,
tension between the two
support at
goals. How do you weight them?
optionpit.com.
How worried are you about one versus
That is
the other?
support
So it's
at
natural.
optionpit.com
I think it
if
would
you don't want to
actually be
call.
surprising if you didn't have a pretty wide range of views based, in this kind of highly unusual situation, and we do. So, but we get together, we discuss, we have a great discussion, and then we
I
decide what
sold
to
my
do.
puts
and
at
we act.
$4.90.
You're right that it's a wide dispersion of views, and I think that's understandable and natural in the current situation.
Hi, Victoria Guida with Politico. You've talked a lot about Fed independence and the importance of it over the years, but as markets have questions
And folks,
about
we're
what
selling off
exactly
big here
President
right
Trump's
now,
intentions are with the
but
Fed, what would
do
you
not be
point
surprised if
to
things
as the
don't
things they
move the
should
other
be
way.
watching to determine that the Fed is still making decisions based on, the economic outlook rather than political considerations?
Look, it's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just everybody who's at the Fed really feels strongly about that way. So,
and folks, you can see the Russell is now down
you'll
on the
know
day.
it by the way
Like I
we
said,
talk
I
about what
always
we're
wait till
doing,
the
by
next
the
day to get
speeches
in,
that people give, by
and
the
I am going
decisions
to be
that we make.
buying
You'll know that we're just still going to do that.
Russell
That's all we do.
2000.
And
the way I'm going to
we don't
express that is with
frame
an
these
in the money
questions at all,
call.
see them in terms of political
So, for
outcomes. I think
instance,
when you
leading
get
into this announced,ment
another
I was
part of
long the
Washington,
IWM
everything
200
is seen
calls.
through the lens of does it help or hurt this political party, this politician.
Batman says RKT
framework.
is a
And I think people find it
screaming
hard to
buy.
believe that is not at all the way we think about things.
Hans
at the
says,
Fed. We're
Mark,
taking
good
a
call.
longer
Fed day is
perspective.
always noisy.
We're
You're
trying
right,
to
Hans.
serve the American people as best we can. So I think you'll.
don't
I mean,
forget,
that's
like-
what I
tell.
sold,
I don't
Surf.
believe
I'm
we'll
actually
ever
going
get
to
to
go.
that
I'm
place.
probably going to buy a different
I would
strike.
say
I will be
we're doing our
sharing
work exactly
For
as
that
we always
play
have now.
in Delta
And
Strike
people are,
tomorrow.
they're making their arguments,
So,
and we're
VIX
having
is looking
really
for a
great
1%
discussion
move,
around
and we
these
have not been
challenging
able to
issues.
even hold a 1% move. We've popped
I know.
You see the court
up,
case
down.
around
I
Lisa
mean,
Cook
it's
as being
ranging like
related.
crazy.
I know. We're
Down,
starting to
down,
rally
down,
again.
down.
I
Nothing
see it as
sustained
a court case that it would be.
We're starting to rally
inappropriate
again.
to
I am going to sell. I'm
comment.
going to offer out the call section of my
Thanks, Mr.
strangle.
Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the
Thanks
with
everybody
interest
for
rates
coming.
on data that seems to be, as you've called
By
it,
the
Yeah,
way.
it's great to see everybody. Give my team a call,
So on the
888-872-3301. Do we have questions for us
the
while we're
revision
watching
that we
this?
saw was almost exactly what we expected. It was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount, and I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies and how many go out of business, how many are founded, and it's just really hard. You can't survey for that.
I'm glad you enjoyed yourself, South Bay Jay.
And it's quite
Watch out
difficult
for
to
that
do, especially when
Operation
the economy
Twist,
is undergoing big changes. So, and they've been
which
working
is
on that
coming
and are making
your
progress
way
on it. But
when we
you know,
get a new
the
Fed
data
governor.
we get is still
So there you go, folks.
well
Starting to
good
get a
enough
little
for us to
rally
do our
here.
work. To the extent we have issues around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to have less volatile data. And the way to get that
Well,
is
you
to
know
make
why
sure
the-
that
you wanna know why the
that
response
agencies
rates
that
are so
collect the
low,
data
Andrew?
have sufficient resources to
Because they use a
drive
fax machine.
higher
They use a
response
fax
rates.
machine
It's
and they
not
use a
complicated problem,
telegraph.
but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll
It's
say
absurd,
is,
really.
Yeah.
in the case of the job creation,
They're-
the response rate is quite
government
low for
is
the first
still
month, or
is the
lower
largest
for the
buyer
first
of
month. By the
carbon
time you get
paper
to
in
the
the
second
world.
or third month, you're still collecting responses for that last month, for that prior month, and you get to the place where the data are much more reliable by the second and certainly the third month. So
No,
it's
they're
not that
not
we don't
sending
get the
faxes,
data,
Hannah.
it's just
That's-
that
it
we
is
get
a
it a
joke.
little later.
But if
Mark in
well, for
Texas says,
benchmarks, if that whole
"Thank you, everyone."
51% of the
Yes.
jobs that we thought were there weren't really there, shows a weaker job market coming into this year. If you had
All right, we're
had
starting to
that
recover here a
information,
little
would it have
bit.
changed
Again,
your
this is
mind
why
related
it's
to
all
where
noise
the
till he's
interest
done
rates
talking.
Should be. Should there have been a cut earlier?
We have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and we take appropriate action. And we took that.
What is
appropriate
carbon
action today.
paper? Does it help the climate? You don't know what carbon paper is, Doug?
Thanks, Howard Schneider with Reuters. So, as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. A black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a 1/4 percentage point now is going to arrest that?
Well, I didn't say that I thought a 1/4 point would make a huge difference to the economy, but you got to look at the whole path of rates,
All right.
right? And markets already
Just
has
got
already
to
been
sell my
baking
calls
in,
on my strangle. Andrew,
expectations.
I
mean,
bought this
our
strangle
market
ahead.
works through
A strangle is when
expectations,
we
right? So I think
bet
our
on how
policy
much
path
the
really
market is
does
going to
matter.
move.
And I think it's
Right. So when you
important
buy
that
a
we use
call,
our
you're
tools
betting
to
that the
support
market's going to
labor
go up.
market.
When you
we
buy a
do
put,
see
you're betting the market's
signs
going
like
to go
that. I
down.
did mention that.
When I buy a
see,
strangle, it's kind of like
minority
betting the
unemployment
over
going up. You
on a
see
football game.
younger people who
and
are
the
more
over was
vulnerable
$4.10.
economically, more
I
susceptible
needed the
to
market
economic
to move
cycles.
$4.10.
That's one of the reasons, in addition to just overall lower
Well,
payroll
I
job
sold
creation,
just the
that
put at
shows you that the
$4.90,
the labor market
and
is
then I just
weakening.
got
would
to
also
sell
point
the
to
call that
labor
I
force
held
participation.
at 50
Some
cents.
part of the significant decline
Nope,
in labor force
bet the under on
participation
the
over
Bears.
the last year
Yeah, no
has
kidding.
probably
Ugh.
been cyclical in nature rather than just the usual aging process. So we put all those together, and we see that the labor market is softening, and we don't need it to soften anymore. Don't want it to.
All right, Matt Man's
So
making
we
money on his
use our
RKT
tools,
calls.
and,
Great.
It starts with a 25 basis point.
Not a great year to be
So
bear.
volatility
market's
in
also
VIX
pricing
in
in a rate
October is
path. I'm
starting
not
to go
blessing
down,
what the
like
market's
VIX
doing at all.
October
I'm just
futures
saying
starting to
it's not
drift
just
lower a
one
little bit
action.
here.
Yeah.
As a follow-up to that, the growth mix right now seems very concentrated in investment and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw that the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, it's spending. So, I mean, I think the economy is moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. Forecasts have been coming up, as you can see. So, labor market unemployment is
Ron
is low.
DMC says, I see
Is-
two.
but,
I
you know,
see
downside
290,000
risks, but
puts in
it's still
IWM
low unemployment rate
at the
So,
233 strike.
that's how we see it.
You might probably. My guess is that is a put sale, not a put buy.
Hi, Stephanie Rule, MSNBC.
A lot of people think just because they see
Treasury
puts,
Secretary
bearish.
Scott Bessent has said that the Federal Reserve
Um,
suffers from
The
mission
traders
creep
sold
and institutional bloat.
290,000
He's now
September
calling for an independent
19th, so this
review. Would
Friday,
you support an independent review, or
233
are you
puts
open to any sort of reform
at 71. Now, here's the interesting part. They
Of course, I'm
they
not gonna
bought
comment on anything
the
Secretary says or
236
really any
puts
other officer says.
193,000 times, and they
So in
bought
terms of
the
reform at the
229
Fed,
puts
we just went
96,000
through
times.
a
So what you're
lengthy
looking
and
at
I
is a
think very
2 by 3 by
successful
1.
process of updating
Kind of a
our
unique trade. So you
monetary
can't just look
policy
at a
framework.
one trade in a vacuum. You have to be able to look at the
I
whole
would say
thing.
there's a
If
lot
you'd like
of
to
work
learn
going
more about
on
order
behind the
flow around
scenes
DMC,
around
Delta Strike is the product for you.
the assets we have in the Federal Reserve Bank system, Federal Reserve system, and at the board. Are they the right size? We're actually going through a 10% 10% headcount reduction through the whole Fed, including the board and all the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that. And I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
Not an independent review?
We're certainly open to, to always trying to do better.
Do you have trade to close at 3, Mark?
Chairman,
Trade to
Neil
close
Erwin
is
Axios.
running right
There's
now,
been some
but
debate lately on
we're
whether
running a
AI
video on it.
is already
I'll
starting
be
to
here
affect the
till the
labor
end.
market in terms of lower
okay.
labor demand, higher productivity by
Oh,
contrast.
you want me to make a? No, they want to know where
do
I
you buy
think
that?
the S&P 500
and
is
if that
going to
is true,
settle.
does that have implications for the monetary policy setting?
So there's great
I said it's
uncertainty
going to
around
close
that.
at
I
50
think
points today.
my
Up?
view, which is also
Yep.
a bit of a guess, but widely shared, I think, is that you are seeing some effects.
I'm going to go
but it's
more
not the
muted.
main-
I'm going to
not
say
the main thing driving it. And so
20.
particular
I'm
focus
going to
on
say
young
about
people coming
20
out
points from here.
of
I'm going to say
college,
66,
and
18,
yeah,
31.
there may be something there. It may be
Everyone write that down.
companies
66,
or
18,
other
31.
institutions that have been hiring
If
younger
that
people
hits,
right out of college are able to
all of
use
you owe
AI
me
more
a
than
penny.
they had in the past. That may be part of the story. It's also part of the story, though, that job creation more broadly has slowed down. The economy has slowed down, and so it's probably a number of things. But yeah, it's
And if it
probably a
misses-
factor. Hard to say how big it is.
If it misses, then
Thanks, Mr. Chairman.
Then I'll be sad.
What evidence do you see of tariffs showing up in inflation?
Well, if you can take goods, just sort of the broad goods
I don't think
category,
so, old guy.
and last year
I don't think
goods
tariffs have been
inflation was negative.
inflationary. That's what he just
You go
said.
back 25 years, that was the
Businesses
typical
have eaten
which is
it.
interesting, right?
was that goods
Yeah.
inflation was
Everybody
goods
was wrong.
prices generally went down, even adjusting for quality.
Well, we'll see. I mean, we'll
So
see.
that was
I
not the
give him
case
give him a
during the
little.
pandemic, of course. Goods
You know,
inflation went
it's a
very
little
high.
early
We
to
had
make
essentially
those kind of
returned
broad
to
sweeping decisions.
zero
So
or
far, we
slightly
haven't seen
negative
anything.
inflation. Now, I think goods inflation
we
over
might.
the course of the past year is 1.2%, which doesn't sound like a lot, but it's a big change.
We're starting to
So we
see
think, I
zero
mean,
zero
analysts have
dated
different views,
options.
but we think it's contributing,
Premiums really come in now,
0.3
folks.
or 0.4 or something like that to the current core PCE inflation reading, which is 2.9%. So it's contributing. What seems to be happening is that the tariffs are
Mark, what would I do
not-
with
mostly not being
$4.33?
paid
Would I head
by
to the sub
exporters,
shop? Yes, I would.
mostly being paid.
I promise I'm going to
by
go there.
Really, the companies that sit between the exporter and the consumer. So if you buy something and
So one of the
sell
interesting
it
effects
through
about
retail or
volatility
you use it to
is
make a product,
we've now
you're
rallied
probably
about
taking those
another
a
10
lot of those
points,
costs on and not
and
able
like
to pass it fully along to the
the
consumer.
option
That
prices are
appears to
not
be
really
what we're seeing.
exploding the way you would expect because
all of those companies and entities in the middle, they'll tell you that they
my
have every intention
my
of passing that through
father-in-law
in time,
absolutely
but they're not
loves
doing
Soupy
that now. And
snails.
to the consumer,
Thanks for bringing him up,
the
Grant.
pass-through has been pretty small. It's been slower
He
and later,
used to make so many
slower and
jokes about
smaller
Soupy sales.
than we thought. But
That
the
just brings
evidence
back a
is
nice
very
warm memory
clear
to me,
that there's
Grant. I
some
appreciate
pass-through.
that.
I also wanted to ask if you could share with us.
Yeah, groceries have
conditions
gotten
under
higher.
which you might consider
That
leaving
is
the Fed
correct.
in May.
But fuel prices have come
I
in.
have nothing new on that for you today.
So like I look at my monthly bill and I look at how much gas has dropped in the last couple
Hi,
of
Katerina
years
Saraiva
versus how
with
much my
Bloomberg
food
News.
prices is.
I just wanted
And
to
I think I'm down
follow
a
up,
little bit, but not a
on,
lot.
one of your answers just a couple minutes ago. We've often heard you talk about how you and your
Oh, another
colleagues,
Bloomberg person.
do not think about politics. This does not enter the room. But one of your new colleagues does come from this
He
world,
already
right, where
answered this
everything
question.
is seen through this framework of politics and of what party is being helped, and that person is still employed by the White House. How can markets and the public
The wilted word
you know,
salad is on
some of
sale. Correct.
his
Oh, wow.
speeches,
Nice
for
little rally
example,
here.
and then
You
some of
might be
the
right.
forecasts that we see today. I mean, the median for this year was moved because of the introduction of his forecast. I'm talking about the number of rate cuts seen this year. What do you say to markets and the public that are trying to interpret, what you guys are saying?
So there's 12 vote, 19 participants of whom 12 vote, as you know, on a rotating basis. So no one voter, can really, the only way for any voter to really move things around is to be incredibly persuasive. And the only way to do that in the context in which we work is to make really strong arguments based on the data and one's understanding of the economy. That's really all that matters. And that's how it's going to work. And I think that is the way the institution, that's in
You're
the
not
DNA
wrong,
of the
Don May.
institution. That's not going to change.
And then I wanted to ask about
we're
a Gallup
continuing to
poll
rally.
that showed that Americans now have more confidence in the president than the Federal Reserve when it comes to doing what's right for the economy. Why do you think that is? And what's your
She's
response?
trying to
What's your
goad him into
message to
saying
the
something
public?
political.
Our response is we're going to do everything we can to use our tools to achieve the goals that Congress has given us. And we're not going to get distracted by
We're
by
now
anything.
green on the
So
day.
I think that's what we're going to do. We're just going to keep doing our jobs.
Really fascinating. I think he answered. I will give him
Jones,
credit.
Financial
He's
Times.
really good when he gets
The
these
range of
politically
views
charged
expressed
comment
prior to the
questions.
meeting, I think there
He
was
is really
a lot
excellent
less
at deflecting.
dissent today
Don't you think?
than a lot of people expected. It'd be
I
good
think
to
he is.
know just what you think the drivers
Yeah.
were
Become
of coming
very
to a
good in
very
political.
strong consensus in the
Yeah,
meeting. And
he's good at
also on the flip
maintaining
side to
a
just
political
explain why the dot
as best
plots
as he can.
are really so scattered.
That AI
and
has trained
someone even
well.
expecting rates to end up higher by the end of the year.
Scavenger's
to
convinced
5
that he's
cuts. I
not
mean,
real and he's
what were the
and
kind of
he's
range of views you
an
heard about
AI image.
on one side why there was so much
I
support
think
for
one
a
of
cut
my
today,
students
and
here,
on the flip
Sergeant
side
Schultz, did a
why
quickie
there's
scalp
so
and
much
weekly profit
divergence about
cycles.
what comes next.
Oh, nice.
I think there's quite a wide assessment that
Nice job, dude.
the situation has changed with respect to the labor market. Whereas we could still say, and did say in July, at the time of the July meeting, that the labor market was in solid condition, and we could point to 150,000 jobs per month and many other things.
None of
I
it.
will give
I
him
think
that. He's
the
got a
new
calm
data
demeanor.
that
They
we've
all
had,
do.
It's
They're
not
all
just
like,
payrolls. It's
I mean,
other things as well, suggests that there
like,
really is
next
meaningful
time
downside
I'm
risk.
having
I said
I
there
have
was
insomnia. I'm just
downside
going to
risk
listen to this
then,
news conference.
but I think that
I'll be
downside
out
risk
in
is
I'll be
now
out in 3
a
minutes.
reality, and there's clearly more downside risk. So I think that's broadly accepted, and so that meant different things for different people. Some wrote down, almost everyone wrote down, supported this cut, and some supported more cuts and some didn't, as you will see from the dot plot. So that's just the way it is. I mean,
Dot
people
plots.
have. It's
All right, we're
you
going
have
green
people who
again.
take this work very seriously, think about it all the time, do their work, discuss it with our colleagues. We endlessly discuss this in between
Yeah, we
ourselves,
got
and
some
then we
range
have a
today.
meeting.
This is
where
why
we
I'm
put it
telling you,
all out on the
folks,
table, and
they
this is what you
are
get.
not.
And you're right.
They, and I mean
there's a
banks,
range of
market
views
makers,
in the
they
dots,
continue
and
to
I
allow
think
event
that's,
risk to be too
like I said,
inexpensive.
very unsurprising given the quite unusual, historically unusual nature of the challenges that we face. But let's remember though, the unemployment
So
rate's
as we've been
4.3%.
talking,
The
VIX is
economy's
down
growing
$1.
at 1.5%.
Oh wow!
So
Slowly grinding
it's not
away.
a bad economy
Volatility
or anything like
futures
that. We've
lower
seen
the
much more
day.
challenging economic times, but from a policy standpoint, the standpoint of what we're trying to accomplish,
All I can
it's
say is say
challenging to know
goodbye to
what
my
to
dental
do.
friend.
There
Volatility.
are,
Oh, yeah.
as I mentioned earlier, there are no risk-free paths now. It's not incredibly obvious
We
what
are
to
all
do.
over the
So
place.
we have to keep
Oh yeah,
our
those
eye on
puts are doing.
inflation. At the same time, we cannot ignore and must keep our eye
So, folks,
on
again, if you're interested in really learning
maximum
about
employment.
VIX and how that
Those
works,
are our two equal
you would want to
goals.
join. If you want to
And
be
you
more
will see
kind
that
of
there are
really
just
an
a
active
range of
trader,
views
that's Rip Zone.
on what to do.
Thus,
Nonetheless,
Rip
we
Zone.
came together
If
today
you're
at the
more
meeting
interested in
and-
kind of
and,
creating
acted with a
consistent
high
trading
degree of unity.
profits that are maybe a little more boring but consistent,
Thank you.
then
Archie Hawke,
weekly
Economist.
profit cycles
You
is
mentioned
your
earlier
trade.
that job creation was running.
So you can give my
below
team a
your
call,
guess at its break-even
888-872-3301.
rate. So I'd be curious to hear a bit more about that,
Shoot an
where you
email,
think the break-even rate is.
support@options.com. And you're
so
eligible for
there are
20%
many
off through
different
the
ways
end of the
to-
day.
to calculate it, and none of them is perfect, but it's clearly come
So
way down.
barely any
There-
reaction
you-
from
you
any of
could-
the
you could say
Bitcoin,
it's
any of
somewhere
the
between 0 and 50,000. And you'd be right or wrong. I mean, there's just many different ways to do it.
Any of the Bitcoin
Gold is now down
wherever
1%.
150,000, 200,000 a few months ago. It's come down quite significantly.
Bitcoin's down 1%.
That's because
Ethereum is down
a very lower amount of people are joining the labor force.
1/3%.
The labor force really not growing much at this point, and
Silver's down
that's
a
a lot
block.
of where the supply of labor was coming from over the last 2 or 3 years. So we're not getting that now. We've got much lower demand. You know, it's interesting.
Gold's climbing up from the
supply and
bottom.
demand have really come down
GDX.
together so far.
Mm-hmm.
Except now we do have unemployment ticking up outside, just one tick outside of the range where it's been for a year. 4.3% is still a low level, but you know, I think this level of this speedy decline in both supply and demand has certainly gotten everyone's attention.
Follow up if I may. You mentioned the downside risk to employment a fair amount, but it's striking that measures of kind of activity
this
now.
be a good
for the
time to
third
buy those
quarter,
wolf
those that we
calls?
have
It
seem
might
pretty
be.
strong. The Atlanta Fed's GDP now is very strong. You mentioned strong PCE numbers as well. How do you square those things? Is there a chance actually could be upside risk to the labor market if those activity measures are right?
That would be an alpha
great.
AI.
We'd love that to happen. So I don't know that you see a big tension there, but it's gratifying to see that economic activity is holding in, and it's a good bit from consumption. It looks like consumption was stronger than expected. What we got earlier this week, I guess. And also we're getting, you know, a fairly narrow sector is producing a lot of economic activity, which is the AI build out and you know, business investment. So you know, we watch all of it, and I would say we did move up. The median for growth for this year actually moved up in the SEP between the June and September SEPs. So and really the inflation and labor market didn't change much. It's really the risks that we're seeing to the labor market that were the focus of today's decision.
Nicole. Hi, Nicole Goodkind with Barron's. Thank you for taking my question. Given the cumulative impact of high interest rates on the housing sector, I'm wondering how concerned you are that current rate levels are exacerbating housing affordability issues and potentially hindering household formation and wealth accumulation for a segment of the population?
You know, housing is an interest-sensitive activity, so it's at the very center of monetary policy. When the pandemic hit and we cut rates to zero, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going, was that we cut so aggressively and provided credit and things like that, and they were able to finance because we did that. The other side of that is when inflation gets high and we raise rates, and you're right, it does burden the housing industry, and so rates have come down a bit, and as that happens, we don't set mortgage rates, but our policy rate changes do tend to affect mortgage rates, and that has been happening, and that'll of course raise demand. Lower borrowing rates for builders will help, you know, builders will help supply, and so some of that should happen. I think most analysts think that it would have to be pretty big changes for it to matter a lot, for the big changes in rates to matter a lot for the housing sector. And the other thing is by achieving maximum employment and price stability, that's a strong economy. That's a good economy for housing. And then the last thing I'll say is, there's a deeper problem here. There's not a cyclical problem that the Fed can address, and that just is a pretty much nationwide housing shortage. Or a lot of places in the country just don't have enough housing for people, and all of the areas around metropolitan areas like Washington, for example, are very built up, and so you're having to build farther and farther out, and so that's where it is.
Why is Washington,
And just a
D.C.
quick
built
follow-up.
up?
During the last SEP or the press conference following the last SEP, you seemed to indicate that policymakers lacked conviction about their projections, and I'm wondering if you still feel that way.
Forecasting is very difficult even in placid times. And
did you just say
as I've
flaccid?
mentioned before,
I think
forecasters are a
so.
humble lot with
I
much to
think
be
he
humble
used the
about.
word flaccid, first time
So,
ever.
I think right now
Is that
a
enough to
particularly
get stocks?
challenging time,
Is that
even
enough
more
to
uncertain
get
than
stocks
usual.
going?
And so I don't know
Can
any
stocks?
forecaster
Oh, he
anywhere
said
really
placid.
ask
Oh, he
ask any of
said
the
placid.
forecasters whether they have great
That
confidence
makes a
in their
lot more
forecast right now. I
sense.
think
I've been
they'll
doing that a
honestly
lot
say no.
lately.
The AI is hallucinating.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. If you're cutting rates,
All right.
why
Once
continue
again, give
to
my team a
reduce the
call,
size of the balance sheet, then
888-872-3301.
pause the unwinding?
Well,
and you can find all,
I think
if you're
we're,
new, you can find
you know,
out
we're,
about
we're
all
cutting
of
the
our
size of our
incredible
balance sheet
services
quite
we have here,
marginally
all the
now. As
cool
you know,
stuff
with
that
the
we
balance
do.
sheet,
And, we want to make
we're
things
still
affordable
in
for
an
you.
abundant
So if the
reserves
Fed's going to cut
condition,
20%,
in which we've said that we would
2%,
stop
or by a
somewhat
quarter
above,
basis point, we're going to cut
a,
20%.
somewhat above an ample reserves.
You've got
level.
pharma
Prevent
stock
the
on there.
Zubin.
And we're,
She
we're
went
getting
right
closer to that.
with
We're
it.
Did Powell just
monitoring very
endorse
carefully.
Pfizer?
We don't think that that has significant
Prevent the Zubin went
macroeconomic
right
effects.
with
These are
it.
pretty small numbers moving around inside a giant economy.
All right, we're trying to get green
level
on
of
the day
runoff is
again.
not very large. So
I
I
want
wouldn't
my
attribute macroeconomic consequences to that at this point.
up 50
And
points.
at his recent confirmation hearing, Stephen Myron brought up that the Fed actually has 3 mandates from Congress, not just jobs and stable prices, but also moderate long-term interest rates. So what does Congress mean by moderate long-term interest rates? How should we understand that when we see the 10-year Treasury moving? And how do you think about this part of the mandate when policy choices like rate cuts or balance sheet reductions affect the long end of the yield curve?
So we always think of it as the dual mandate,
This
maximum
reminds
employment
me
and
of
price
teaching.
stability
I
for a
already
long
answered
time
that question.
because we think moderate long-term interest rates are something that will result from stable inflation, low and stable inflation.
All right, Mark, I'm going to pop off. I'm
maximum
going to finish
employment.
my
So
other jobs.
We don't.
All right.
We don't
Everybody,
we haven't
thank
thought
you.
about that as for
Yeah,
a
we'll
very
continue
long
to
time
play this till
as
he's over.
a third
I'd
mandate
like to
that
remind you
requires
one more time.
independent
Give my team a
action.
call,
So that's where that is.
888-872-3301.
And there's no thought of, as far as I'm concerned, there's no thought of
And
considering
again,
that,
we're offering
you know,
20% off through the end
considering
of the
that
day
we
on any
somehow
product other than
incorporate that
trade to
in as
close,
something in a
game
different way.
plan, and Alpha AI. So
Every time we get up to
your
even
triple
SPX,
mandate is
Thanks,
to
Chair Powell. Matt Egan from CNN.
Yeah, your triple mandate is
we
888
recently learned that
872
average FICO credit
and
scores are
3301.
down this year by 2 points, the most
Alternatively,
since
it can be
2009 during the Great
support
Recession. And
at
delinquencies are high for car
optionpit.com.
loans, personal loans,
Give us a
credit
call
cards.
to take advantage of that
How concerned,
20%
if at
off
all,
sale.
are you about the health of
And
consumer
again, keep an eye on
finances? And do you expect
IWM.
today's
And based on
cut
what we're
will help?
seeing, I'm with Andrew, and
So,
I really like those high
we're
dip
aware
stocks.
of that. I think this default
All right,
rates
everybody.
have been kind
For
of ticking
Andrew
up,
T.
and we do watch
Giovinazzi, our
that.
Viking of Volatility, and the Option Pit
They're not at a
Director
level.
of
I don't believe
Education.
they're at a
I'm
level
Mark
where
Sebastian.
overall
I am the
they're,
CEO and founder of
terribly
option.com.
concerning, but it is
I am
something that
also
we watch. Lower rates
your
should support
only
economic
option.
activity. I don't know that one rate cut will have a visible effect on that, but over
Have a good
time, a strong economy with a strong labor market is what we're aiming for, and stable prices. So that should help.
Just to follow up, this rate cut is coming at a time when the stock market is at or near all-time highs, and some valuation metrics are elevated historically. Is there a risk that cutting rates could overheat financial markets, potentially fueling a bubble?
We're tightly focused on our goals, right? And our goals are maximum employment and price stability. And so we take the actions that we take with an eye on those goals. Separately, and that's why we did what we did today. Separately, we monitor financial stability very, very carefully. And I would say it's a mixed picture, but households are in good shape, banks are in good shape. Overall, households are still in good shape in the aggregate. And I know that people at the lower end of the income spectrum are under pressure, obviously. But from a financial stability perspective, we monitor that picture. We don't have a view that there's a right or wrong level of asset prices for any particular financial asset, but we monitor the whole picture, really looking for structural vulnerabilities. And I would say those are not elevated right now.
Jean, we'll go to you for the last question. Hi, Chair Powell. Jean Young with M&I Market News. I wanted to ask about inflation expectations. You've said the Fed can't take the stability of inflation expectations for granted. You mentioned at the short run, they've
gone up a little bit. I wonder if you can talk a bit about that. And then also at the long run, I'm wondering, do you see evidence that the debate over Fed independence and the growing deficit is putting pressure on inflation expectations?
So as you said, shorter term inflation expectations have tended to respond to near term inflation. So if inflation goes up, inflation expectations will predict that it takes just a little while to get back down. Fortunately, throughout this period, longer term inflation expectations, both break even in the markets and almost all of the longer term surveys, Michigan being a bit of an outlier lately, have been just rock solid in terms of running at levels that are consistent with 2% inflation over time. So we don't take that for granted. We actually assume that our actions have a real effect on that, and that we need to continually show and also discuss our commitment to 2% inflation. And so you'll hear us doing that. But we're, as I mentioned, it's a difficult situation because we have risks that are both affecting the labor market and inflation. Those are our two goals, and so we have to balance those two. When they're both at risk, we have to balance them, and that's really what we're trying to do. Your latter part of your question was about independence. I don't see market participants. I don't see that that's something they're factoring in right now in terms of setting interest rates. Thanks very much.